Now, I welcome you to this technical analysis part two. I hope you were able to spend some time on basic formations which we saw earlier. Before we even move on to the formation, we need to make up our mind and say we are price action people. Yeah, we take our decisions based on the price. We don't take decision based on the TV news. We don't take based on the newspaper, what we read on the newspaper and what our competitors or neighbors are telling. Yeah, what somebody is telling. We don't take action based on that. We take purely our action based on the price. That's what we saw. Then we saw that candle is nothing but actually is a collective what should I say? It's a collective consciousness. Yeah, a single candle is signifies a collective consciousness, but a group of candle actually makes it. What should I say? It's a formation. It gives a shape of a formation. Now, based on which we have seen so many patterns, we understood so many patterns. Now we need to watch it. We need to give a closer look at the charts. Whenever we are watching the chart, you should be looking out for these points and what happens subsequently. This is the first part. Now we'll be moving to the second part. What do we have it? What do we have in the second part? Now let's try and understand some of the theories now. Based on these candlesticks and patterns, there are some theories made. Now this Doe theory, which is over 100 years, it's one of the oldest theories we have. This applies every day, every moment, every second. This is like, Doe theory is the most important theory. Like, it's very basic. It's very basic. Now, what do you mean by a Doe theory? Yeah, the Doe theory is very simple. It actually denotes some of the phases. Like, is there an accumulation phase? Is there a participation phase? Is there a distribution phase? Yeah, that's what. How do you denote this? As long as the market is making higher high, which means the close is higher than the previous close, it's a bull. It's a continuation of bull trend. If there are lows being made and there are no new lows are being created, the low is lower than the previous low, yeah, then it's bearish. So if the trend reversal has to happen, yeah, the high has to cross the low. Definitely, when there is a change in trend, obviously it has to, it has to reverse, and then there has to be higher highs. The bottom should be higher, the high should be higher, the bottom also should be higher, the high also should be higher. The market is making newer highs, the bottoms are higher. If the bottom from the previous bottom is lower, no, it's actually again a bearish signal. Similarly, in a negative downtrend, it should be making newer lows. Even the high should be lower highs. Lower highs, lower bottom denotes negative trend. Higher highs and higher bottom denotes upper trend. Now, typically what happens in the market scenario, there is an accumulation phase. This is where, you find most of the institutions, they would be accumulating silently. They would picking up volumes, and then suddenly people start noticing it, and they participate. There is a whole rush for people to buy, people start accumulating. And then whoever has bought earlier will slowly start distribution phase. That is where you will suddenly see that there is a volatility in the market, and the price range is fluctuating. Yeah, this is how the market operates. This is what the basic Doe theory is all about. As we go ahead at every stage, we will find this in the bottoms and the high determining the direction or the trend of the stock. We'll be talking more about trend as we go ahead. Then the next most important theory as we go ahead is actually in Elliot wave theory. This theory identifies waves identified as impulse waves that set up a pattern, and corrective waves that oppose larger trend. What do I mean by this? The larger trend is actually the market is in an up move, but there are some smaller moves. There are some smaller moves as it goes ahead. So the smaller move in an up move, the small downward move doesn't make it a bearish signal, but it's essential, which is, you call it as a retracement or whatever. Elliott wave theory is a method of technical analysis that looks for uh, recurrent long-term price patterns related to persistent changes in investor sentiment and psychology. Again, as I told you, it's a collective conscious. As we are talking, it's about collective conscious. Now here it tries to measure. Now, I'll introduce you to this theory, and then I'll tell you what does the world think about the Elliott wave theory. Now, usually they try to measure any wave in a five number, one, two, downward, then there is upward three, then there is a four, there is a five. The follow-up movement is called as an A, B, C. After that, again they say one starts. This is typically, this is how they try to understand Elliott wave. Now we will come to the retracement much later. How much it retraces, we will come to that point much later when we cover Fibonacci. We'll be covering Fibonacci, and then you will understand how much does it retrace. Retrace is nothing but whatever is the up move, how much does it try to cover the previous rally. Okay, we'll come to that later, but we are trying to understand the Elliott wave. The one flaw of Elliott wave, I'll tell you, he himself, the person who actually discovered it himself, he said, if you put me as well as if you put 100 Elliott wave practitioners in one room, and then you give them the same graph, there will be 100 different ways of drawing the wave. End of the day, everybody is right. Yeah, end of the day, everybody is right. So that is how individualistic it can be, arcing the wave. So there is no perfection here, or there is no accuracy here. But basically, we all know that market moves in this wave. End of the day, you'll be able to capture those 5 waves. Yeah, they say the fifth wave is the largest movement. Yeah, we're talking about the fifth wave bull run is coming. Yeah, it depends on what period you are actually looking at. Yeah, they look at, that is how it is a wave theory. We will again revisit this when we revisit Fibonacci. Yeah, because the retracement is important. We'll be studying retracement also. Yeah, okay. Now I think, yes, it's right in front of you right now. Actually, when it retraces, how much ever, after the first rally, there can be a 50% retracement can also happen, 50% of the rally. Suppose, let's say there is a movement, 100 rupees stock that made about for 8 rupees movement, there can be a 4 rupees actually correction happening. From then again, there is a movement. There is again a movement on only about 38% it can retrace like that. Every movement, there is every movement, there can be a 38%. Now, what are these 38%, 50%, 161%? We will learn it when we are covering Fibonacci. We don't have to worry about it exactly. We will cover it there. But there is some percentage of retracement also that happens, which is predictable. Which you can usually follow. Yeah, so we're going to see that this is about the Elliott wave theory. Now I come to the most important is about the Fibonacci retracement. Now, what do I tell, or how do I introduce you Fibonacci? Fibonacci is nothing but a sequence of numbers. These are sequence of numbers. What are these sequence? Basically, the sequence, like when you add a previous number to the current number, the follow-up number is actually a Fibonacci. Simple, basic. It starts with 1. Yeah, 1 plus the previous number is 1. 2 plus 1 is 3. Yeah, 3 plus 2 is 5. 5 plus 3 is 8. Yeah, 8 plus 5 is 13. 13 plus 8 is 21. And then it goes on. The number goes on. But what's significant is this. Here the significance is actually the ratio between the two is 1.6. Yeah, so we're talking more about this same Fibonacci. Now, what we do this, whenever there is a large rally, we try to measure how much percentage of that rally covers is actually understood in Fibonacci retracement. Now, also, whenever there is a breakout, we usually see the breakout also, whether it is an upward uptrend or in a downtrend. Whenever there is a breakout, we try to measure this. First is actually until the stock crosses about 38%, there is no direction. Then, as you can see in this chart, it is very clear. Once it cracks the 38% level, then the next most important is the 50% level. Then it is actually the 61% level. And then once it crosses 61%, it is called breakout, because that's where the big movement is going to come until 100%. Yeah, there are some intermediate levels, but basically after 61 is 100%, and from 100 it's actually 140. That is the amount of correction it happens. These are the big moves. Basically, we start seeing big moves right from the moment it cracks 61%, whether it's on the upside or whether it is on the downside. So now this is about Fibonacci retracements. As you can see, even in this example, what we're trying to do here is, first there is a downtrend which was measured. Now when the market started taking a U-turn, the first is actually the 23% point. It has to cross that. Then there is a 38% point. The market went up, but it actually corrected. Then the breakout, as you can see, there is actually how many attempts for the breakouts? There is one attempt, there is two attempt, attempt number three doesn't fulfill. It goes, then it takes support subsequently, and then it reaches to 100% mark. This is the normal pattern. That is where, as a trader, you should be focusing on identifying stocks which is actually sitting at 61% mark, which actually, whether on the upside or on the downside, because that is where the next big movement is going to come. That is where there is a confirmation of the direction. Not until even 38% or 50%, not until the 50% level is crossed, there is no confirmation. Only when it crosses that level, there is confirmation. So as a trader, it will be our duty to understand, when which stock is actually crossing the is the 61% mark. Now, coming back to the Elliott wave, this is what I was actually talking about. Whenever there is a correction which is happening, as you can see here, after a big up move, there can only be a 38% correction, which is healthy, definitely healthy, and then the market retraces back, it moves back. Or it can be a 50% movement, or sometimes even 61%. It can take support at 61% and then move back. But what do you say? What happens when it cracks below 61? Change in trend. It's a downtrend. It's a breakdown. Then it's a breakout actually at this level. There's a breakout, and then there is a completely change in trend. Not until it breaches 61%. It can actually take support at 61%, which is a healthy correction. Anywhere between 38% to 61% is a healthy correction in a bull market. And then the market usually moves up. And can you see some gaps also happening here? The moment it crosses the mark, the moment it crosses that mark, there is so much of buying power, so much of bull strength. There is a gap of opening. Now, don't you think that this will act as a big support? When the market corrects the further, this will act as a big support. Yeah, this is about the retracement. We have understood how exactly the market retraces before it actually moves up.